This lesson will review the effectiveness ratios, accounts receivable turnover, average collection period, inventory turnover, and average. For us to calculate effectiveness ratios, we need two things from the income statement. The first is the total revenues, which are against our accounts receivables. And the second thing is we need the cost of goods sold. The last thing that we need to calculate the effectiveness ratios is the inventory number, and we get that from the balance sheet. Now let's talk about the second type of ratio. These are called effectiveness ratios, and they indicate how effectively the company is managing its receivables and assets by looking at the turnover rates of each. The first ratio is accounts receivable turnover. This is equal to the net credit sales divided by the average accounts receivable. This ratio indicates how quickly the company collects on its accounts receivables. The next ratio is average collection period. This is the days in the measurement period divided by the current liability accounts receivable turnover. It indicates how quickly a company is collecting on its debt. The third ratio is inventory turnover. This is equal to cost of goods sold divided by the average inventory balance for the period, where the average inventory is the beginning inventory plus the ending inventory divided by 2. This ratio shows how many times the inventory is sold and replaced over the period. The last effectiveness ratio we're going to talk about is inventory turnover period. This is equal to the days in the measurement period divided by the inventory turnover. A low inventory turnover value could indicate that the company is stocking the products that are in demand and selling. As we did on the other ratios, let's take a look at XYZ's effectiveness ratios. To calculate accounts receivable turnover, we need to know what was the prior ending account receivable. We need this to calculate the average accounts receivable. This wasn't given to us earlier. So, for the purpose of this example, let's just pencil in $100. Using this, and since we know this period it's 750, the average is 425. Also, the 750 sold this period was all credit and hasn't been paid yet. Therefore, the info gives us a ratio of 1.76. To understand the significance of this value, in other words, is it good or bad, we need to compare it to the standard for XYZ's industry and evaluate it against the stated credit terms. We can determine XYZ's average collection period using the accounts receivable turnover we just calculated. We're letting this period be a quarter, so the days in the measurement period equals 90. Dividing that by the 1.76 that we just calculated gives us a collection period of 51 days.
Did we do something wrong here?
I assume you mean because it's greater than 30 days? If that's what you're asking, then the answer is it depends. As we stated before, we need to assess the period against the industry standard and against XYZ's set terms. If the terms are net 30, XYZ is not doing a good job, so it's bad as you stated. However, if the terms are net 45 or 60, well, then it's not so bad.
Well, moving on to inventory turnover ratio, things don't look any better.
Using the numbers we've been given, you're right. COGS was $250. Inventory valuation at the beginning of the period was 0, and it was $19.50 at the end of the period. This gives us a ratio of 0.26. To help understand why we're saying this is bad, let's take a look at the next ratio, inventory turnover period. The average inventory turnover period is found by taking the 90 days in the period and dividing it by 0.26 inventory turnover ratio that we just calculated. This gives us a turnover period of 346, which indicates that XYZ has enough inventory for almost the entire year. Anyone would question, why did they make that extra purchase?
Let's share with the students some follow-up lessons we have that can help them continue with their transition to management.
That's a good idea, Daniel. Some lessons that the student would want to take a look at would be creating a cash flow statement, creating an income statement, creating a balance sheet, profitability ratios, and liquidity ratios. If you enjoyed this lesson, like us on Facebook, subscribe to our YouTube channel, and visit our website.